Federal Drive is presented by GEHA, Government Employees Health Association, proudly providing health and dental benefits to federal employees and their families. Visit GEHA.com.
And now, the Federal Drive with Terry Gerton, sponsored by GEHA.
Welcome to the Federal Drive on Federal News Network. It's Monday, December 8th. I'm your host, Terry Gerton, and I am glad you're here. Coming up on this hour of the Federal Drive, the federal flood insurance program is key to stable housing markets, but the shutdown revealed its fragility. Plus, centralization is back in vogue, but is it the right model for government shared services? Those stories and much more ahead during this hour of the Federal Drive. We begin with this. In the Army, a new acquisition bureaucracy is starting to take shape. It means new names for some long-standing Army organizations, but at its core, the reorganization is about letting Army officials manage the acquisition system as portfolios of capabilities, with less of a focus on individual programs. That idea has been championed by outside reform advocates for years, but now it also has the support of the Secretary of Defense. We get the details from Federal News Network's Jared Serbu.
Taking a less program-centric and more portfolio-oriented approach to acquisition has been a consistent reform theme since at least 2019, when the Section 809 panel on acquisition reform recommended it in its final report. The Congressional Panel on Planning, Programming, Budgeting, and Execution Reform raised the issue, too, as part of its recommendations. So did the House and the Senate in their respective versions of the latest defense authorization bill. And last month, it got the explicit endorsement of the Secretary of Defense.
We will leverage taxpayer dollars in a more accountable, flexible, and deliberate manner to maximize their value across capability portfolios. We will shift funding within portfolios' authorized boundaries, swiftly and decisively to maximize mission outcomes. If one program is faltering, funding will be shifted within the portfolio to accelerate or scale a higher priority. If a new or more promising technology emerges, we will seize the opportunity and not be held back by artificial constraints and funding boundaries that take months or even years to overcome. And we will partner with Congress at every step of the way for seeking maximum flexibility empowered by transparency. Instead of each program acquiring its own infrastructure, portfolios will invest in common platforms, interfaces, and test ranges. No more endless delays or bureaucratic gridlock. No more customized acquisition pathways. The battlefield doesn't work that way, and neither should our capability development.
In that address at the National War College, Defense Secretary Pete Hegseth credited the military services with laying the groundwork for some of the reforms he wants to make department-wide, and the Army started its implementation work last month, naming 6 new portfolio acquisition executives. Each of those PAEs will oversee different capability areas, with programs managed by what had, up until now, been called Program Executive Offices, and will now be called Capability Program Executives. But Brigadier General Christine Beeler, the Capability Program Executive for Simulation, Training, and Instrumentation, says there's more in those portfolios than just the former PEOs.
The PAE is going to be able to wrangle all of those enablers. We are one enabler to the PAE. In our PAE for C2 counter C2, it's us. It's our friends over at CPE IEWS and our friends over at CPE C3M. Right? Those are the 3 acquisition folks. Then we're going to have contracting. You see programming. So there are folks up at Big Army that are going to help us on the programming side. Whether that's programming for us coming out of the TT PEG or the EE PEG, all of those things are also in flux. There's a working group to redesign and republish how the Army runs, which is the authoritative Bible of how does the big green machine continue to roll along from dollars in to lethality and deterrence out. You can see we've got system centers, RDT&E, you got requirements folks. The beauty of the requirements community now under T2COM is they all basically report to the same 4-star now. We're going to have other decision-making bodies to participate in, but all of that can get combined and come to us in a single requirements community of practice so that the PAE, things that get decided at their level, will be easier to understand and make trades on.
Beeler speaking at a staff town hall meeting late last month. Last week, another one of those former PEOs announced the details of its own internal reorganization. Leaders of the newly dubbed Capability Program Executive for Command, Control, Communications, and Network say most of their changes will be at the program manager level, both to align with the Army's broader acquisition transformation agenda and to orient the office more explicitly around the Army's plans for next-generation command and control. The changes there include 4 new program offices for applications, data and AI, infrastructure, and transport, plus changing roles for several other offices. CPE C3N officials expect to detail the changes during the next Army Technical Exchange meeting at Aberdeen Proving Ground next month. Beeler says there will be program office changes within her organization as well, but the reorganization will take until the summer of 2027 to fully unfold. Along with that, she says, will be a reduction in senior officer positions.
Key changes were a mandated reduction of command select list billets by 30% at both the 06 and the 05 levels. So that means over time we're going to transition from 3 CSL billets to 2 CSL billets at the 06 level, and from 8 CSL billets eventually to 5 CSL billets at the 05 level.
And at the even more senior levels, Beeler says the end state of the Army's acquisition reorganization is that the new PAEs will be 2-star generals or the civilian SES equivalents, and the CPEs will be 1-star positions. But those details, like many others in the reorganization, are still subject to change.
This is a very time and event-driven process. We're not jumping in tomorrow, both feet, bam, everything's changed. That wouldn't make any sense, and we would lose the discovery part of how these pathfinder adjustments to the acquisition process are actually going to work. But for the time being, we will be the capability program executive, STRI. We believe in the future we're going to change, and we're going to change the logo, and we've got some ideas out there for how we're going to do that over time. But at the end of the day, this is what we're going to do, right? We simulate the fight, we replicate the threat, and we're going to make sure that the Army can win across all domains.
Jared Serbu, Federal News Radio, part of the Federal News Network.
You can find Jared's story at federalnewsnetwork.com. Up next, centralization is back in vogue. But is it the right model for government shared services? This is the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. The Trump administration's second-term strategy leans toward consolidating acquisition, HR, and financial management under a centralized approach. But that's a departure from the marketplace model of its first term. John Marshall and Steve Goodrich are here to discuss what that means for agency autonomy and service quality. John is the founder and CEO of the Shared Services Leadership Coalition, and Steve chairs the SSLC board. Steve and John, thank you both for being here.
Thanks, Terry.
Thanks for having us, Terry.
John, I want to start with you. You've been with the shared services concept for a long time. You've seen Trump 1 and Trump 2. Tell us how their approach differs across the different administrations.
Well, thanks, Terry. It's a great question. We're not really sure what the approach is for the current administration yet, because they haven't released a president's management agenda. But we can get some signs from what we've seen out there and kind of reading the tea leaves a bit. But the first Trump administration had a very clear plan. It was announced in OMB Management Memorandum M-1916 and included an innovative approach to creating a marketplace of shared services providers through 4 quality service management offices, or QSMOs, that were set up to manage financial management, human resources, cybersecurity, and grants marketplaces. Those were allowed to continue through the Biden administration. They weren't really expanded or empowered very strongly or resourced, but they still have existed. But we haven't seen the Trump administration, the second Trump administration, endorse or expand them. They seem to be continuing the financial management and grants. We're not sure about cybersecurity and HR. So a lot is yet to be seen. What we have seen from the second Trump administration is a strong focus on centralization and consolidation of common services. They don't seem to include some of the key features of shared services that we'd like to see, but they're heading in a positive direction, and we like most of what we've seen so far.
Well, Steve, let me turn that to you then, because in addition to what John's talking about the centralization approach, the Trump 2 administration has issued executive orders around acquisition, HR, and financial management. Are you seeing that approach get traction in any particular way?
They are a little bit. As you know, GSA is also revamping the FAR and actually to include shared services within Section 8 of the new FAR when it's issued. GSA is focused on procurement. OPM is focused on HR. Treasury is focused on finance. They all are starting to make traction in a centralization model. They're at different levels or different stages right now, but they're certainly getting there. OPM has their RFP out to try to develop a centralized approach for government-wide HR support services. GSA is pulling procurement into GSA more and more. And Treasury is at its beginning stages, working with its QSMO, actually, to develop and make sure they have the systems and the foundation before they can start operations down the road.
So, John, in Trump 1, you made the point that there was a lot of space for initiative and choice in the marketplace. Centralization seems to be pulling that back. Are you seeing agencies respond in a positive way?
I don't think we have really a lot of great feedback coming from the agencies yet. They haven't been very communicative about their adoption or their plans for centralization or shared services. So a lot is yet to be seen. We're kind of reading between the tea leaves right now and trying to determine how things are going to sort out and what the agency responses will be.
In market theory, markets will be more efficient than a centralization model. What do you have as an expectation here?
Well, we have a lot of reasons to prefer a market-based approach because of competition, and particularly a marketplace would allow industry service providers to participate and compete with government service providers. We're a little uncomfortable with the idea of just consolidating everything in centralized government-delivered, government-operated functions because they tend to, over time, they become monopolies and pretty bureaucratic. And so we like the idea of having a more open marketplace where competition can drive continuous innovation and customer choice and let the marketplace then sort out the winners and losers.
I'm speaking with John Marshall. He's the founder and CEO of the Shared Services Leadership Coalition, and Steve Goodrich chairs the SSLC board. So, Steve, let me come back to you then. Shared Services Leadership Coalition has proposed a more competitive standard-based model. Tell us about that and how your proposal differs from what you're seeing the administration currently implement.
Well, the administration is trying to move fairly quickly right now, and with technology solutions, frankly, before they get process and governance and policy and data reform in place. So they're moving out fast. The centralization model, as John says, may not be the optimal model to get there. What we're proposing is a strong mandate for shared services because, as you know, it's come and gone from over the last 40 years from administration to administration. And to get there, we need Congress really to mandate it so we can consolidate the common services across government to get there. 2, we need a strong governance structure to be able to operate, lead this across agencies, and get the right mandates and security and systems and so forth and so on. Within that, we then need to do the right analysis and design of the right approach to make sure we're consolidating appropriately, that we're getting the duplication of systems and processes down, and we can actually measure the outcomes that we're getting to make it happen, and then have an effective transition process.
Tell me about your governance model. Who would be in charge of oversight there?
Well, our proposed model, we have the OMB-DDM as the policy director, if you will, for this and the authority. We have GSA leading the operations through a management center. And then there's roles for the PMC There's roles for the agency's advisory going through this as well. And you have the operating centers to make sure this is done and done right.
Are you hearing from any of those agencies that they're interested in taking on that governance role?
There's GSA would have interest in getting there. As you know, OSPI, which has been drawn back over the years, was the original design, as the M1916 says, is the coordinating element. But our proposed legislation would actually give it the authority it needs, led by a commissioner within GSA for government operations with which to get there.
So, John, let me come back to you because you mentioned something in your last response that I think ties in with this governance piece. When you get a government centralized service function, it tends to become a monopoly, but it's also really hard to invest in technology modernization. How would you see this centralization model staying current and actually addressing the service concerns of the federal agency constituents?
That is a great question, and I think that the flip side of that question sets up the response that we would like to see, which is the marketplace. Because if you had a marketplace with industry and government service providers, you would have continuous competition across the service providers and customer choice, which should provide the incentives to drive innovation in the marketplace by all those providers. So it's a really important feature that we think ought to be incorporated. And we're concerned that government centralized services haven't had access to appropriations or technology modernization funds for modernization. So we're concerned that they would follow the example that we've seen too often of centralized service providers not modernizing, not keeping up, and becoming non-responsive and antiquated over time.
Steve, you want to follow up?
Yeah, I would. You can look at good models like Canada. Texas has done a pretty good job of developing partnerships with industry. And so that moves away from the traditional FAR, firm fixed price contract approach, where as technology advances, as process or new policies advance, the companies involved, the partnership involved, are responsible for the implementation and bringing those new technologies to the forefront without contract change orders and things like that. It's built into the process.
So, Steve, as you look forward, what sorts of policy or legislative change is SSLC recommending?
So as it really tees off what I was saying before, putting a piece of legislation in place that mandates shared services, that sets up the governance structure, that ensures that there is metrics, both performance and outcome metrics, that are measured and reported back to Congress and the President, that involves the PMC in this process, and builds the strong demonstrated consolidation of common services across government to save money, to improve data, to reduce duplication, to get us there finally with a modernized system of policy, process, and data.
So, John, I want to wrap up with you. Legislative change is sometimes an interesting windmill to tilt at, but in the absence of that change, if the administration continues with its policy of centralization, what should agencies and industry partners be doing to prepare for that?
Watching and seeing what comes out from the administration and following suit. But we'd like to see more interest in Congress, and it's hard to get legislation passed in this area. We've been trying at this for 10 years. We've seen a history of legislation, the CFO Act, GPRA, and so many other landmark pieces of management legislation. They take a long time. The incubation period is a long time. So we'd like to see industry working with us and agencies showing support for a more fundamental transformational approach like we're offering. And don't forget, Terry, what we're proposing is a mainstream business model that's used by 80 or 90% of Fortune 500 companies for managing common services. And the potential savings are tremendous. We've estimated $75 to $100 billion in potential savings. So that's really what's on the table for the value, not just improved services for employees and for customers of the government and taxpayers. This is a great opportunity that the government shouldn't miss.
Steve, let me give you the last word.
Yeah, John and I like to joke sometimes that, and it's true, it's not a joke. For over 40 years, we've been sitting in meetings around shared services with OMB and oversight agencies, and it ebbs and flows from administration to administration, or they just dance around the edges. a bill passed and signed by the president will finally give it the energy and resources it needs to move it forward.
I've been speaking with John Marshall. He's the founder and CEO of the Shared Services Leadership Coalition, and Steve Goodrich, who chairs the SSLC board. Thank you both for joining me.
Thanks for having us, Terry.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts. Still to come, House drama over the defense bill sets the stage for a high-stakes December on Capitol Hill. But first, the flood insurance program is key to stable housing markets, and the shutdown revealed its fragility. You're listening to the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. The National Flood Insurance Program is a lifeline for communities in flood-prone areas. But during the shutdown, its borrowing authority plunged and new policies froze. That disruption rippled through housing markets and raised questions about the resilience of federal disaster programs. Joining us to review what happened and what's next is Nicole Upano, Assistant Vice President of Public Policy at the National Apartment Association. Ms. Upano, thank you so much for joining me.
Thank you, Terry. It's a pleasure to be with you.
Well, as we speak, the shutdown is at least temporarily over, but it left some major disruptions in its wake. And one of those programs that we want to talk about today is the National Flood Insurance Program. Can I ask you first to tell us what that program is, but then also talk about how the shutdown and the extension of the shutdown affected that program?
Sure. The National Flood Insurance Program is an important program for single-family home buyers as well as multifamily owners and operators. It is a backstop to ensure that borrowers have flood insurance, even in areas where there is elevated risk, and private insurance companies may be less likely to offer coverage in that area without having some sort of elevated cost because of their risk. So it's a very important program for many Americans.
And it really provides a stability in markets that are flood prone, right?
Ready. That's exactly right, Terry. It is an important program for many Americans. It provides stability in the market if there is a national disaster to ensure that money flows back into that community for rehabilitation and repair.
And during the shutdown, NFIP's borrowing authority dropped dramatically. What does that mean in terms of practical terms?
That means that, as I had mentioned previously, this program is flood insurance is an important part of home sales and multifamily sales. And without that borrowing authority, those purchases could not move forward since it is a contingency to home buying. And there also is that greater risk that if a natural disaster could occur, that there wouldn't be an ability to fill those claims and push financing back into those communities.
So the way that works then is in a disaster, FEMA actually uses that borrowing authority to pay out the claims that it may receive. Is that correct?
That's right.
So then how did the lapse in the NFIP operations affect home buyers who rely on that flood insurance to maybe close on a mortgage?
We have certainly seen this across the federal government for many HUD-assisted or agency-assisted programs, that it put a pause in those home sales until the government is back up and running and doing the people's business.
So we're in a continuing resolution now. Did the CR provide additional borrowing authority for FEMA through the National Flood Insurance Program?
Yes, it sure did. It reauthorized it since September 30th. And there is a piece of bipartisan legislation that was also offered that would reauthorize the program until 2026 to provide even greater certainty for homebuyers and renters across the country.
Does that mean that folks who were kind of in limbo for the last 40 plus days of the shutdown can renew their policies or maybe submit their claims? Does that open the window back up?
Yes, it certainly does.
I'm speaking with Nicole Upano. She's the AVP for Housing Policy and Regulatory Affairs for the National Apartment Association. So, Nicole, let's go back to the program itself. Even with existing policies still active, there were some limits. What do policy holders need to know about their coverage, their claims, and their change in funding if we should find ourselves in another funding lapse, perhaps?
Sure. So if someone had a valid policy during the shutdown, those remained valid throughout the shutdown. But if in terms of a new policy or a renewal, that's where the rub would be, as well as potentially processing any claims. There would be limitations on that.
Did you see any misconceptions or misunderstandings on the part of policy owners about what services and coverage would be available to them during the shutdown?
NAA represents professionally owned and managed housing across the country, and so they kept the shutdown and any implications very much top of mind and continue to use NAA as a resource to get the most up-to-date information.
And so you're dealing with apartment owners, condo owners, those kinds of things. What are some of their biggest questions when it comes to the NFIP program?
Well, for our members, they are looking across the federal government at all the implications. For example, HUD and FHA, they provide financing and backing not just for affordable housing, but for market rate housing as well. So there was an issue with those closings. And while Section 8 and USDA rural housing benefits for renters and their families in rural areas, while those benefits did benefit from an advance appropriation, there was that similar issue, similar to the NFIP, that renewals and new applications could not be processed, and there would have been payment uncertainty for those renters and their families. And so having government back up and running and doing the people's business is important to both housing providers and renters to ensure the stability of those properties and that renters in those communities remain stable.
NAA is obviously very sensitive to the real estate market, especially in flood-prone or disaster-prone areas. Beyond NFIP itself, what does this moment really reveal about the fragility of our disaster response programs and how people can get relief if they're affected?
Sure, that's a great question. Many of the federal government's housing programs are not mandatory appropriations. And we've seen that with other industries that they are seeking now opportunities to have a backstop if and when this happens again, to ensure that agencies can access reserves or that they can expand their budget authority in these times, knowing that eventually the government will be back up and running and folks will be repaid.
How should policymakers then, or legislators, be thinking about long-term resilience and continuity for programs like NFIP, especially as climate risks grow and shutdowns maybe remain a threat?
Well, we would certainly encourage policymakers to reevaluate whether some of these programs should have a mandatory appropriation so there won't be disruptions. We never know what's going to happen, certainly with climate risks and change across the country. And so having that certainty is critical.
So what is NAA's message then to housing providers and renters on navigating these kinds of disruptions? What do they do to stay informed? How do they make sure that they're current? What's your advice?
Yeah, so NAA continued to release live updates on our website to our members. We continue to encourage our members to work with their residents as their business allows and provided them with resources and how to navigate those conversations. We were pleased to see that the CR does include a reversal of the rifts that happened during the shutdown, and especially for folks in the DMV, this is extremely helpful to ensure there's certainty for those residents and that housing providers can know they have a stopgap at the end of the day.
And what are you hearing from lawmakers? Are they inclined to support those kinds of proposals?
Yeah, as you can see from the bipartisan legislation to reauthorize the program in 2026, this program has long had bipartisan support. We just want to use this time to encourage policymakers to take that next step.
I've been speaking with Nicole Upano. She's the AVP for Housing Policy and Regulatory Affairs at the National Apartment Association. Thanks so much for joining me today.
Thanks, Terry.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts. Still to come, House drama over the defense bill sets the stage for a high-stakes December on Capitol Hill. This is the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. Lawmakers are scrambling to bring the NDAA to the floor this week amid partisan clashes. The Senate is preparing a vote on health care subsidies, but appropriations bills remain stalled. At the same time, a Supreme Court case on Humphrey's executor looms large in the background. Lauren Duggan, Deputy News Director at Bloomberg Government, is here with the Inside Scoop. Lauren, thanks so much for joining me.
Thank you for having me.
This might be a big week on the Hill. The House is planning to bring the National Defense Authorization Act to the floor for a vote. It's obviously a topic we talk a lot about, but last week there were a lot of, let's just say, conversations about what might be in it and how it might go. So tell us about what's going on behind the scenes.
Well, this bill, it's a must-pass piece of legislation. They've been doing it for decades, and they always want to get it done by the end of the year. And this year, there aren't a lot of other end-of-year vehicles, so it's kind of become an attractive venue for discussions about a number of issues. So that's kind of what's been going on. It's probably less about the core part of the NDAA and more about some of the ancillary things or related things that people want to get in there or keep out of there, as the case may be. We saw a particularly big dust-up you might be referring to between Elise Stefanik, who's a member of leadership, but was mad at her own leader, Speaker Mike Johnson, about trying to keep something out. And in the end, they worked something out, and that was getting resolved toward the end of the week. But that was just one of the flashpoints that leaders were dealing with, trying to assemble this very important bill.
It is normally a bipartisan bill. Is there a chance that, that's not going to be true this time, even with the slim majority in the House?
It may still be bipartisan because they do try to work things out. And, sometimes the initial versions that come out of the House are particularly partisan because of riders or language that the minority party might not like. But they were reaching for consensus here. They were trying to get the four corners to agree on things before they went in. That's the chairman and ranking member of the House and Senate committees, not just the defense committees in this case, but sometimes the other committees that had legislation that was in the mix. So they're trying to get a bipartisan package that can get through, because you might lose people on either side, but maybe you have the consensus you need to get something through. So we'll be watching that vote counting very closely as they move toward the vote.
Is there any aspect of the move forward on the NDAA that is also impacted by the hearings on the Hill last week about the counter-drug operations in the Caribbean?
Those two things seem to be on different tracks. I mean, obviously they're related. It's about the Defense Department and the Defense Secretary and what people might think there. But the legislation and setting policy is sort of moving in one direction, but some of the same players are also very much involved in reviewing what had happened with the ordering of these strikes and the chain of command and all the issues. We had the members watching the video over on the Senate side and reacting to that last week. I think that will continue. It may be brought up in the context of the debate or larger questions, but I think the bill will move regardless of that. And Congress can, because they do this every year, revisit it in next year's NDAA or perhaps in other legislation, because we've already seen members talking again about maybe war powers or other things they might tap into there.
Well, we'll see how that comes about. But speaking of votes, there is also supposed to be a vote in the Senate this week on the health care premium subsidy extensions. What's the prognosis there?
Well, this was part of the agreement to reopen the government, was that there would be a vote by, I think, December 12th was it, so Friday, on some sort of vote around the ACA extensions that are expiring at the end of the year. Chuck Schumer, the Democratic leader in the Senate, said he'd aim for a 3-year extension, which would take us obviously beyond the next election. That's a different proposal and one of many proposals that are floating around. We'll be watching to see, does the GOP answer with their own proposal, and what does this mean for the House, if anything? So, going toward the end of last week, there was still no consensus on how this would be fixed. It will have to be bipartisan, obviously, to get over the line, and we may not be there by the end of the week, but maybe we'll have some discussion and votes ahead of that.
And Mike Johnson's trying to put a package together on the House side as well, right?
Right. And there's more than just the ACA being talked about here. There's health savings accounts ideas or other things that members might want to pursue. You kind of got this short-term issue of what do you do with the subsidies for next year, but then there are a lot of people who are trying to bring in, what does this mean overall about the Affordable Care Act, the nature of the markets? Does there need to be a broader sweep of changes? But there's not really consensus on anything broader than this. We'll have to see if there can even be consensus on the smaller question of what to do with the subsidies.
I'm speaking with Lauren Duggan, Deputy News Director at Bloomberg Government. Well, Lauren, at this time of year, every time we talk about the status of the rest of the appropriations. Shutdown or continuing resolution expires at the end of January. What are you seeing in terms of the move forward on the other bills?
I'm sort of seeing kind of a whimper on that going into the end of the year. To be honest with you, January 30th is a long time away. There's been a lot of talk about what would be in a next minibus package that the Senate might consider, but that hasn't been moving forward. Votes haven't been scheduled. And without that sort of end of the year deadline or mid-December deadline that often drives that activity, they have more time, and usually work expands to the time allotted. And I think we might see that here. So not clear that we'll get more votes by the end of the year on that. There are a lot of issues they're trying to work through. But that will be, if they don't do it now, obviously top of mind when they return in early January, because the clock will be ticking.
Loudly at that point. A different topic, and we don't cover the court very often, but there's a very important case on the Supreme Court docket for today, dealing with the president's effort to fire a member of the Federal Trade Commission. Tell us what your team is watching there.
Well, part of our organization is Bloomberg Law, and they cover many court developments around the country and certainly at the Supreme Court. They're watching this very closely because it has huge implication for independent regulators. As you mentioned, Kelly Slaughter, who was a FTC commissioner, was fired by the president and has had a court battle that's now reached all the way up there. And it goes back to a precedent called, I think it's Humphrey's Executor, which there are many people in this building who are far more versed than I in that. But it's going to be closely watched, because what is the nature of an independent regulator? What is their power vis-a-vis the rest of the executive branch? Big questions there that have effects on a lot of different institutions and therefore a lot of different regulated entities by those institutions. So we'll be watching the arguments, and then the decision, whenever that comes, will be very closely watched.
So what else are you watching for the coming week?
Well, we're watching the Senate try to move forward on another batch of nominees. I think it's 90 or so. They tried to do it last week, but there was a procedural hiccup, so they're starting over. But that would be, if they could get that done, another 90 Trump appointees on the job by the end of the year, which Republicans would like. And we're also watching, hearings. There's a lot of other nominees going through, and there'd be a flash of celebrity. Gene Simmons of KISS is actually scheduled to be up on the Hill, so we'll be watching to see what he brings. Always interesting when you have kind of that celebrity star power. Trying to shine light on an issue.
That's a hearing near and dear to the heart of radio broadcasters everywhere, so we'll be watching it as well.
Excellent.
I've been speaking with Lauren Duggan, Deputy News Director at Bloomberg Government. Lauren, thanks as always.
Thank you.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Hear the Federal Drive on your schedule. Subscribe wherever you get your podcasts. Hundreds of thousands of federal employees have left their job this year due to the Trump administration's efforts. Now, the Office of Personnel Management is telling agencies to start rethinking their senior executive staffing, too. The request comes as OPM introduces a number of other changes for federal managers. And here with the latest is Federal News Network's Drew Friedman. Drew, thanks for being here.
Nice to be with you, Terry.
Right. What is the latest on senior executive staffing?
So what we're seeing potentially going forward is going to be a reshaping of the senior executive staffing levels across government, kind of in response to what we've seen more broadly across the federal workforce. What we know so far is that OPM in a late November memo told agencies, or really encouraged them, to consider reducing their staffing allocations for senior level positions as a result of those federal workforce cuts more broadly. So OPM in this new memo says that by December 19th, agencies will have to submit a workforce assessment where they detail their current staffing allocations for senior level positions, and then also how much they plan to reduce those allocations going forward, if they do have those plans at all. This is going to cover everything from senior executive service or SES members, as well as those in senior level positions and scientific and professional positions as well. So OPM here is really just following what the Trump administration has already been trying to do more broadly to really just reduce headcount overall. And now they're saying this is going to affect SES as well.
Refresh us on the overall change in the federal workforce over this past year. And if you can break that out, how many were SESs?
Absolutely. So we know that over the course of the year, about 317,000 federal employees have so far left the government. This surpasses OPM's prediction or expectation of about 300,000 employees over the course of 2025. And we still have about a month left, so it's possible those numbers could change a little bit more in the next couple of weeks. But generally, what the Trump administration has been going for is essentially a 1-to-4 ratio of 1 employee entering government and 4 employees leaving government. That's kind of what they've been trying to stick to for the course of the year, according to some of their guidance and memos. A lot of that comes from the deferred resignation program, others from reductions in force, of course, the probationary employee firings that happened earlier this year, some level of retirement of employees. So all combined, it is a pretty significant reduction to the workforce. And I think we're going to see more ahead in the coming months or potentially throughout 2026 as well.
So you're not predicting that they will be lifting the hiring freeze anytime soon?
So for the hiring freeze, it's a little bit unclear how this is going to look going forward for agencies. Technically, it seems to be starting to thaw at least a little bit, but with a lot of new requirements at agencies for what their staffing plans are going to look like for the long term. So an executive order from President Trump in October told agencies to start creating strategic hiring committees, as they called them, and that's going to set a lot more parameters around the hiring process and workforce planning at agencies. So, for example, it's going to bring in a lot more political appointee oversight into the hiring process. So there is a move towards now, okay, we've reduced the workforce by this much headcount overall across government. Now, what is your reshaping going to look like into 2026? Agencies are expected to start putting those staffing plans together. It's possible that could include more hiring, but that would again have to have the approval of both political appointees on those strategic hiring committees, as well as the approval of both OPM and the Office of Management and Budget. So essentially, the hiring freeze is not necessarily in place, but there's still going to be a lot more oversight going forward.
Going back to the senior executive topic that we started with, there's only about 7,000 of them across the federal government. And OPM has put out a lot of guidance about them. Do you have a sense, if you pulled it all together, what would be the impact on that group of people?
I think it's going to be a lot. It's hard to say in one specific way how things are going to really change for the SES for the next coming months, coming years. But there's definitely a lot of focus, for example, on the president's priorities. That keeps coming up in a lot of this guidance for the SES. And we've seen that stretching back to President Trump's first day in office, when he had an executive order saying that senior executives need to be held more accountable and really focus on the president's and administration's policies. Since then, we've seen that bleed into a lot of different areas, especially from OPM's guidance. So that can include everything from changing the performance plans and performance management standards for the SES. It's coming into a lot of training opportunities for the SES and just a lot of other ways where the administration is really focusing on making senior executives come back to the policies of the administration overall. So I think that's kind of the through line for me, but there's a lot of changes that I think we're going to see over the course of the next year or so.
One of the big newsy ones is that the final rule on schedule policy career is about ready to come out, and that will have a big impact likely.
Absolutely. We know that OPM has estimated about 50,000 career federal employees might be impacted by that final rule. That's the estimate. We don't know exactly how agencies are going to begin implementing it. And there have been previous estimates that show it could be as high as 200,000 federal employees who might be impacted by that change. But just for a refresher for our audience, the schedule policy / career final rule, that's essentially a reemergence of the Schedule F policy from President Trump's first term. So essentially taking career employees who are in what they call policy influencing positions and removing their workforce protections to make them at-will workers and easier for agencies to fire if they believe that's the right decision. So it's not necessarily going to mean outright that number of employees will be removed from their jobs, but there is going to be a pretty significant change, I think, after that final rule from OPM comes out.
And a big impact on the senior executives in that process. Lots to watch coming up.
Absolutely. I think we're going to see, everything from, again, the training changing, the performance management standards changing, job protections changing. And again, it really ties back to the Trump administration saying that they're trying to add more, as they call it, accountability from senior executives. So I think there's going to be a really big reckoning for that group of the workforce going forward.
That's Federal News Network's Drew Friedman. Drew, thanks for keeping us up to date.
Thank you, Terry.
You can find her story at federalnewsnetwork.com. The Federal Drive with Terry Gerton is produced by Eric White and Michelle Sandiford. Our web editors are Daisy Thornton and Stephanie Wright. For the latest updates, stay with federalnewsnetwork.com or follow us on Facebook, YouTube, and LinkedIn. I'm Terry Gerton. Thanks for listening.